How to get rich during a recession. It is no surprise that we are currently facing tough economic conditions. For both the Australian economy and the American economy, we have seen the fastest rate hikes in history, which have caused a lot of pain for both consumers and businesses. We have had bank failures under the tight credit crunches, and in Australia, the average mortgage owner is now paying an additional $1,200 per month on their mortgage compared to last year. This has resulted in consumers spending less, as their discretionary income is going to servicing debt payments, which ultimately lowers business revenue for non-essential businesses. So everybody is facing it tough, and it is no surprise we are headed towards a recession. However, the governments find this necessary because this is all in the fight to bring inflation down, because the consequences of hyperinflation are worse than a mild recession. So in today's video, we are going to cover how you can better prepare yourself in this recession and make more money. Recessions are inevitable. They will come and go, so you need to know how to maximize the opportunity because riches are made in recessions. The first key step to getting ahead in a recession is to stay invested. As hard as it is, you must stay invested. Your initial instinct when the stock market begins to trend down is to sell your stocks, but that is absolutely the wrong mindset. You should see a stock market decline as a buying opportunity. From its low point in October 22, the S&P 500 is up 24.56%, and from its low point in December 22, the Nasdaq is up 35.38%. Had you sold off your investments and stayed out of the market, you would have had missed out on the enormous comeback the market has had since. Stock market dips are the best buying opportunities to buy stocks because they are at a discount. The same way people rush to a store when their favorite item goes on sale should be the same way people react in the market. However, funnily enough, people react to the complete opposite and feel the need to panic sell. If you bought 100 shares of a stock, right, at $50, and now that same stock halved in price and is now selling for $25 a share, for the same cost basis, you can now buy double the amount of stock you owned previously for the same purchase price. So that means your average share price would go down from $50 a share to now $33 a share. However, you would have doubled the amount of shares you owned. And when the market recovers, this then amplifies your returns. The super investors are an exceptional examples of this. Many of them were buying heavy into the market last year when it dipped, including the greatest investor of all time, Warren Buffett. So let's see what Warren has to say about this.
It's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life. And I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. But they have that feeling that they just feel better when stocks are going up.
The next key concept you must know to get rich in a recession is to invest in yourself. As cliche as this sounds, this is one of the best pieces of advice you can get. Spending money on yourself to get higher education, further qualified, or learning a new skill can be the most profitable investment you can make, because all of those things can help you earn more money, and that certification cannot be taken away from you. This even occurred to me in my personal life. Last financial year, I earned 50% more than I did the previous years because I attained a certificate in my line of work that made me more qualified, and it allowed me to earn more money. A small piece of A4 paper was the best investment I've made all time because it will continue paying its dividends for as long as I am in this industry. So believe me, I have holdings in my portfolio that have given me 20 or 40% returns in less than a year. However, my best investment was investing in my education. So look at what you could do to make yourself a better asset to yourself and your employer, and take the right steps forward, because its returns will continuously compound. So I hope you can take the advice, because in a high inflation period, the best investment you can make is in yourself. Now, the next piece of advice Warren gives, it's key, and it's about building a fortress balance sheet. So now let's listen to what Warren Buffett has to say.
In terms of the potential for a credit crunch coming through what the banks are going through right now, there's been a lot of speculation about what that could mean to the economy. Is it going to mean a 0.5% hit to GDP? Is it going to mean a 1% hit to GDP? What would you guess?
I would say that I've been in business running Berkshire for 58 years, and I've never found economic forecasts of any use to the company. And all we have to do is keep running every business as well as we can, and we got to keep plenty of cash on hand so that people can keep making intelligent decisions rather than those forced upon them. And that's all we know how to do. And if I depended in my life on economic forecasts, I don't think we could make any money. I don't know how to do it. And people want to get them, so they get them, but it has no utility. When I find one of our companies has hired somebody to tell them what's going to happen in the economy, I mean, they're throwing the money away as far as I'm concerned.
The final tool you need to get rich during the recession is cash. You need to load up on cash. This is what Warren meant by building a fortress balance sheet. Cash is your best weapon to fight against anything in the recession. Cash is your offense and defense. It is your offense when you need to take advantage of a market dip, and your defense if your income slows down, reduces, or disappears temporarily. Without cash, it is more difficult to invest in yourself, and without it, the first two pillars we covered today are pointless. In an environment where there is rising interest rates and lowering inflation, cash is not trash. It is king. So remember to buff up that emergency fund. As interest rates are rising, it is better to keep your cash in a high interest savings account rather than just a normal savings account, because your money can be earning you a better return in one while you wait for a good opportunity to invest in. And when that opportunity comes, grab it with both hands. So that's all for today's video, guys. I hope you take everything Warren and myself said on board. Thank you guys for watching, and please don't forget to like, comment, and subscribe to my channel. And if you enjoyed today's content, share this video with a friend, and I'll see you again in the next one.